So welcome everybody. So today we have Zhang from Stockholm School of Economics. We will talk about does ESG investing help VC funds to attract startups? Emanuele, Colonelli will discuss. So as usual, so if you can turn on your videos, that would be great. So it makes the seminar more interactive. So if you have questions, so you can raise your hand, or you can put it in the chat, and then we'll call you, and Ye will answer the question. So if we will also have extra time at the end. So if you have questions as well, so yeah. So Ye, so the floor is yours. So
thanks, Kenway. Well, thanks for the opportunity to share this work. Feel free to just interrupt me because sometimes I may not pay attention to the chat room. Yeah. So the motivation is quite straightforward. Most industrial greenhouse gas emissions actually come from private firms. And so that's the reason why impact investors in the private markets play an important role, because we hope to use our green funding to make firms greener, right? But unlike trading stocks on the public market, we know many investment processes in the private market involves a matching process. So investors and firms choose each other. Then while investors, we want to make firms greener, what about firms' perspectives, right? What if they just say, no, I don't want to accept your green funding, and then that will be a serious issue. So here, when looking at the existing literature on sustainable finance in the private market, many papers mainly focus on the firm side, on the investor side, right? Studying investors' investment strategies, or their green investors' financial performance, or their motivations behind sustainable finance. And so this paper actually focuses on the firm side. So essentially, I want to understand how do firms choose between ESG and profit-driven investors during their fundraising process. And specifically, I'm only focused on the startup VC context because it's an ideal testing ground for this question. So based on the paper written by Steven Kaplan, Bergson-Soy, and Pear, so they show that companies' business model remains relatively stable from startup to IPO. And then if ESG investors, we are able to change startups' business models from the beginning, and then the positive effect might last for a long time. And also entrepreneurial financing process is a pretty representative two-sided matching process. So the insights obtained by this paper might also be helpful to other investment process, say the loans market or the bonds market. And the last point is about the feasibility perspective, right? It's just more possible to recruit startup decision makers compared to the CFOs of Goldman Sachs. And then this allows researchers to conduct field experiments and address multiple empirical challenges in this setting, right? So for example, in the private market, we don't have a very well-developed ESG rating system. And also generally, we only observe the equilibrium matching outcome. And so running field experiments will just help us to address all of these issues. So essentially what I do in this paper is I run field experiments in the US, and then essentially all my subjects are US founders. In the formal study, there are 409 anonymous US founders. I recently just replicated my experiment with additional 65 founders whose businesses are listed on Crunchbase. And so, many results are, still similar across different samples. And then regarding the experimental setting, the goal is try to provide real personalized investor recommendation services to our startup founders. So during my recruitment process, I realized that there's already some startup called Superwarm AI. And then so their business model is the same as my experiment. They provide some AI powered, recommendations to both startups and investors. And so essentially this paper contains two main experiments. The first one is a classical IRR experiment. The goal is to try to test any belief-driven mechanisms or financial reasons behind founders' fundraising behaviors. And since I recruit those 65 founders on Crunchbase, I'm able to link founders' previous fundraising data to their experimental behaviors. And from the perspective of running experiments, I feel it's pretty cool to have this payment game. So this is a new experimental design created by this paper in order to identify taste-driven preferences. Basically I want to elicit decision makers' preference, but in the field setting. So let me see. We can ask questions. Oh, okay. So what I found in this paper is just, generally startups are less enthusiastic about green funding. So similar to the VC side, I found startups actually face a tension between profits and preference. So first I found founders, they sort of are less enthusiastic about VCs focusing on environmental impact, mainly due to financial reasons. So on the one hand, they feel like working with environmental VCs is less helpful for us to increase profitability in the future. And also they feel like, those environmental VCs might also don't want to invest in our companies. So due to both the profitability concern and also this matching concern, they found like startups, they don't like environmental VCs. But it doesn't mean like our founders are bad people. Actually, I do find some causal evidence from those payment game that these founders have positive ESG preference. It's just like, when you trade off between profits and preference, as the founders of startups, you want to survive first. And so financial reasons will dominate in their behaviors. And of course, there are substantial heterogeneity, right? So for example, ESG-based matching happens, which means ESG startups prefer ESG VCs. And also founders' political affiliations, investor gender, startup size, industry backgrounds all play a role in this process. So let's talk about the literature and contribution. Right? So this paper has both empirical and methodological contribution. So first, it adds to the literature on impact investing in the private market. As what I mentioned, many papers actually focus on investors' investment decisions or motivations. But this paper provides the evidence on the other side, on the firm side, which helps to determine the equilibriums in this matching market. And also, it provides some micro empirical foundations for firms' ESG preferences, which is pretty helpful to recent sustainable finance theory. So when we look at those theoretical papers, I found like, theorists, they have already started to examine more generalized situation where all market players or all agents have some degree of ESG preference. And so this one just, shows that besides investors, actually, we do find some evidence on the firm side. This also adds to the literature on the ESG initiatives. So previously, people want to bundle E, S, and G together, but then this paper sort of found like E and S are quite different. They also have slightly different implications for founders' collaboration intentions. And so lastly, it adds to the literature on entrepreneurial finance, showing that VC's ESG characteristics also matter to their deal flows. So regarding the methodological contribution, this paper provides a new experimental design to study preference in the field setting. Previously, when we check how to elicit decision makers' preference, the toolbox we have includes trusted games or dictator games. And then a common critique I received, is, how do we know that participants' behaviors in the artificial task in the lab can be generalized to the field? Right. So now that motivates me to design this payment game, so that it first complements the LR experiment by showing whether subjects are willing to pay for those provided matching incentives, those matching recommendation surveys. And also it elicits preference in the field setting, right? So while LR shows we want to sell you some recommendation service, and then the payment game asks, how much money you want to pay for this service? So question.
You have a question in this chat.
Sure. So is it correct belief for the founders to believe that ESG founders are less likely to secure funding for the future? Sure. So this one is actually, I think that's correct because I remember in one of my other working papers studying how VCs choose between profit-driven startups and ESG startups. You do see that profit-driven VCs prefer profit-driven startups, and then ESG VCs, they don't discriminate against those ESG startups. So I think we do have some market segmentation in this, at least along the ESG dimension. Could you explain on what do you mean by ESG startups and investors? ESG VCs tackle environmental challenges, or rather ESG aware. Okay, so later in the experimental design part, I will show you the wording describing everything. So here, I would say it's more about startups and VCs that tackle environmental challenges instead of just ESG aware. Yeah, thanks. So let's look at the first IRR experiment. All right, so each founder evaluates 20 randomized VC profiles. This provides exogenous variations. So founders know all the investor profiles are hypothetical, no deception. But then the more truthfully they review their preferences, the more likely they will receive their matched VC's information. So that's a matching incentive. So each component of this pager will be orthogonally randomized. And so here in the control group, the investor just mentions that they works in a profit-driven VC fund. And then the goal is try to make our existing portfolio companies on their way to great success or scale faster. And then as what I mentioned, this sort of mimics a real world setting by providing personalized real VC recommendation service. And so here, VCs are randomly assigned to be either profit-driven VCs or ESG VCs. And so ESG VCs will be further decomposed into environmental VCs, which mentions like, we mainly want to invest in startups that tackle environmental challenges and combat the climate change. Or some social VCs, which mentions, we mainly want to help the underprivileged group and generate positive social impact on our community. And so G here in this paper is mainly about female leadership. So I remember my research teams, we search all of those real world descriptions of ESG VCs on their websites, and then the only one that's about G we can find is just about improving female leadership in the management team. We don't find any VCs mention, we care about the transparent disclosure of their information. And they also have some VCs who claim, we aim for both environmental and social impact. So those will be called ESG VCs in this paper. And so for the evaluation questions, the founders need to provide some profitability ratings, right? Mainly evaluate how likely this investor can help them improve profitability in the future. Or the matching rating, which is how likely do you feel the investor will be interested in investing in your company. The third channel is about informativeness. For example, some founders might feel ESG VCs are not familiar to them and they require more information of this profile. And so regarding the decision questions, the most important one is a contact interest ratings. That is, how likely do you want to receive those information, the contact information of that investor? So I felt like this contact interest ratings has a much stronger correlation with founders, fundraising outcome data. And also we also ask them, hey, how much money you want to raise from each VC? So those are the theory-based evaluation questions. And now let's come to this payment game, right? So the goal of the payment game is to elicit preference. And then so the intuition is quite straightforward. So imagine if subjects' behaviors are mainly influenced by their beliefs and preference. So if beliefs can be fully controlled by researchers, then founders' decisions will be indicative of their preference. Then how to design an experiment that can, follow this intuition, but, the setting is a field setting. So my idea is try to test whether founders prefer to pay or purchase ESG VC's contact information when we tell them that, well, the recommended ESG VCs and profit-driven VCs have the same matching quality, right? And so basically in the control group, the founders, they just decide, you have two options. One is, you just receive some lotteries. And option two, you spend some money on purchasing a more expanded investor recommendation list. So in the control group, those are just normal investor recommendations. But for the treated group, I just tell them to promote ESG campaign conditional on similar matching quality. We will prefer to recommend ESG investors. And we check, whether the founders in the treatment group are more willing to pay for this recommendation service. So their decisions are fully incentivized by the lottery. In the most ideal case, I probably want to sell my recommendation list to the founders and make money, become rich based on my research. It's just when I applied for IRB in graduate school or even at SSE, all the IRBs, like they don't allow researchers to do this. So that's the reason why, you have to compromise a little bit by providing the incentive based on the lottery. Otherwise, if someone can collaborate with the warm AI startups, and probably, you can start to sell this business to founders and then track this again. So the third one is actually a donation game. So the donation game essentially follows a Riddle and Smith's JF paper, and then donation measures social preference. Then if we found pro-ESG founders also donate more, this provides some suggestive evidence on founders' ESG preference. So again, all of those questions are incentivized by some monetary stakes. So who are those founders, right? Originally, when people think about founders raising VC funding, the stereotype image are Elon Musk, who plan to say colonize or conquer Mars. But in reality, I found like founders seeking VC funding are really diverse, right? So we have some extremely cool, talented founders who use deep learning, machine learning, AI algorithms to build online services, or someone who helped to improve the security on the cloud storage service or the 3D printing. But at the same time, we also have some founders who own an organic shrimp farm, right? So their business model is try to sell organic seafood to people, or some Spanish teachers who want to open an online school that can teach the next generation of the US to speak better Spanish. So basically, like the pool of founders are really diverse. You have some pretty classical businesses. You also have some fancier ones. So this is the demographic information of the formal experiment, right? So for those 409 anonymous US founders, they are recruited by Qualtrics panel. And then I run this experiment between 2021 March to 2022 April. And then those founders will consider VC funding. They understand the incentives. They're also willing to provide careful evaluations. And so after passing those screening questions, they will enter this study. So one thing is like there are more female founders actually in this formal pool. So in general, like most of these recruited startups, they are seed stage startups looking for funding, and then they cover almost all industries which draw VC funding. And so I also replicate this experiment with Crunchbase founders during the previous 2 months. So results are pretty similar, but then like here you're gonna see the female founders. Generally, we have fewer female founders in the Crunchbase platform. Unfortunately, I found, like we don't have a very ideal or perfect benchmark database telling us who are the total pool of founders looking for VC funding, right? So we know like on Crunchbase, generally we have more higher impact startups, but then of course we might have fewer female founders on this platform. But when we try to, like expand our subject pool by including some smaller business owners, right? Especially here, I do found some founders here are the owners of art studio or the gym studios, right? We have more women here. So this doesn't affect their evaluations of environmental VCs, but to some extent, it will affect their attitudes towards social VCs who aim to help the underprivileged group. So I will elaborate those results later. So let's talk about the results, right? So first, I show that startups they really don't like environmental VCs. This is a sad news. Why? Because first, if you look at the OLS regressions, right? And then startups that generally feel those environmental VCs will hurt their profitability compared to profit-driven VCs. At the same time, they also provide much lower matching ratings to these environmental funds. So because of these concerns, they are less likely to contact environmental VCs. However, when we look at column 4, after controlling all of those belief-driven mechanisms, we don't find any evidence showing that they have preferences against ESG. So this results about environmental VCs is fairly robust among like Crunchbase founders or startup founders who want to purchase the recommendation list, right? Those who value the incentives more. And so what drives this profitability concern? So to answer this question, I also run a complimentary survey with 281 US founders during the summer. And so it seems like founders' profitability concerns are mainly driven by the cost of environmental mandates. So they believe that, for a VCs aiming for environmental impact, they might ask me to change my business model, use more clean technologies. This is so costly for early stage startups. And also they feel like environmental VCs, their main expertise probably is about generating positive environmental impact instead of making money. So Kenley, question?
Yes, I have a question. So, so did you find some heterogeneity depending on what is the industry of the startup? Like, I don't know, like if you, like, for example, the shrimp farms that you showed at the beginning might be, might care more about like environmental VCs than others. So.
Yeah. There are indeed some heterogeneous effects. Like the most E-friendly industries include finance, IT, and clean tech. And those who are most against environmental VCs are transportation and logistics, and construction industry. So definitely, like later we're gonna see E startups are more friendly to E investors, and the S are more friendly to S. That's a so-called matching, I think. Yeah. And so another thing I found is about the distributional effect. High quality environmental VCs are less affected. I want to mention that this distributional effect is not very transparent or obvious to people. So when we look at discrimination literature, right? So even though any discrimination behaviors are fully driven by beliefs or statistical discrimination, theory shows that sometimes you might see high quality candidates are more affected. Sometimes it's low quality candidates are more affected. It really depends on other deeper parameters in that environment. So that's the reason why here, like when I check the distributional effect, it seems like it's mainly low quality VCs are affected by, aiming for environmental impact. So to be more specific, I use other orthogonally randomized VC characteristics to generate an objective VC quality measure, Q4 hat. And so I decompose all of those investors into low quality investors versus high quality investors, right? And so here you're gonna see that when checking their evaluations of those high quality investors whose predicted quality is above 50, and then we don't see much significant results among this subset pool. But then when we examine the low quality investors or VCs, you're gonna see that founders provide even lower ratings to those environmental VCs if their historical performance was not very satisfactory. And so these results got confirmed at quantile regressions, and similar results also hold among Crunchbase founders. So now it seems like if you belong to the top tier VCs, right, say Red Points, Sequoia, and then sure, you're fine. You can just basically aim for ESG. It doesn't hurt you that much. And so here you can see that among those high quality VCs, aiming for social funds, aiming for social impact might make you even slightly attractive. But if you are not the top tier VCs, right, you just belong to some low quality investors, you're the first time founds, and then things become slightly tricky. Aiming for ESG might hurt your overall deal flows. And so next, I try to link the experimental behaviors with fundraising data, right? So when we look at the experimental literature, there is a general consensus that when experiment stakes are low, subjects will behave in a more prosocial manner and also have noisier behaviors. So, given that my results are not that prosocial, and then we have some significant results, probably the stake concern is not a big issue. However, to further convince you, like I just use those Crunchbase founders information to check whether their experimental behaviors have correlations with their fundraising outcomes. So among those 65 founders, roughly 43 of them have a fundraising history, which is recorded on Crunchbase and PitchBook. So I found that, like founders who previously got funding from EVCs or environmental VCs, they do seem to be more friendly to these type of investors in the experiment. So these correlations sort of also verify the stake of this experiment. So now let's look at the payment game, right? So payment game is when ESG and profit-driven VCs have similar matching quality. You don't need to worry about any type of, like financial reasons anymore. I do find like founders are more likely to pay for this ESG VC's information. And similar results also hold for Crunchbase founders. So here, when using OLS regressions, you can see that compared to the control group, the ESG investors' information are more attractive to founders. So, probably they are 13% more likely to purchase the VC's information when we tell them that, we want to slightly recommend more impact investors in your recommendation list. And so similar results also hold among those Crunchbase founders, although due to the sample size, the significance level is slightly weaker. And also, since in this payment game, both the price of the recommendation list and also the number of ESG investors are orthogonally randomized. So I also use a random utility model to quantify what is the willingness to pay for this ESG investors information. And so the results shows compared to the control group, founders roughly have about 50 to 70, US dollars more willingness to pay for this. But of course, that measurement have some have a large standard errors. And so what's interesting to people probably is this ESG-based matching results, right? So the market segmentation. Overall, we just found that compared to profit-driven startups who only aim for profits, ESG startups that actually have more positive views towards ESG funds, including both E funds, social funds, and the overall ESG funds. And so similar results also exist among Crunchbase founders, right? And so when we examine E and S separately, so this is a result. You will see that overall E startups are more friendly to E funds, although this is less significant because the classification of E startups are mainly based on their industry backgrounds. And S startups prefer S funds. What's interesting is those orange box. So S startups don't necessarily aim for or want to get funding from E funds. So here is E prefer E, S prefer S, but it doesn't mean S prefer E, right? So there are some, so that spillover effect is not here based on this table. So similarly, when you look at their intended fundraising amount, similar patterns here, profit-driven rating evaluations, similar patterns here, and then availability ratings, we have similar patterns here. So that's about the matching part. Given that we still have more times, I can also talk about some results about S, about the social VCs. So here, when I check the evaluations of founders who want to purchase a recommendation list, right, who place higher value to the incentives, I found VCs aiming for social impact actually have higher contact interest ratings from founders. And what's even more interesting is that after controlling all the belief-driven channels, the coefficient of these social VCs still remain highly significant. So that sort of suggests that, preference might play a role here. So later when I check the correlation between their coefficients in the IR experiment and donation games, I also found that those who are more friendly to social VC funds also donate more money to ESG NGOs. So all of these results sort of support the positive, preference towards social VCs. The only issue is when I replicate the experiment using Crunchbase founders, because you have less women in that sample pool. And I found the attitudes towards social funds or governance funds also become negative. So here, a lot of these positive attitudes towards social VCs are mainly influenced by female founders. And the reason is because, the social VCs in our experiment are those who want to help the underprivileged group or generate some positive social impact for the whole community. And the government's fund is about targeting or improving female leadership. And so I found male founders are not enthusiastic about, those government funds or social funds. And so this result is pretty consistent with the literature in the sense that, we have some working papers showing that polluting firms want to use charitable giving to rescue their social image. Because, those firms they view as less costly than E. And so similarly, I found this figure like in the impact investing paper written by Barbara Morse and Ayako Yasuda. And so here, if you look at the willingness to pay of limited partners of VC funds, you see like the willingness to pay is highest for environmental funds, but slightly lower for those social infrastructure, minority women, or poverty, right? So in their paper or model, willingness to pay is negatively correlated with the VC funds returns. So I think this plot sort of indicates that, generally speaking, environmental VCs might have even lower returns compared to those social VCs. And so that's about the effects about S. And so lastly, we have lots of heterogeneous effects. So what I found is that Republican founders are actually more against the ESG compared to Democrats. And also regarding Kamala's question about an industry background, right? I found like, industries that prefer ESG the most actually include IT, clean tech, education. And those who prefer E the most is like IT, clean tech, and finance. Those against E is like transportation, logistics, or energy. And I also found some size effect in the sense that smaller startups are more against E, but larger startups with total number of employees about 100 people, they're slightly more friendly. So they're not against E, right? So I think this result also, got found by some recent climate finance papers, which shows that climate regulations or carbon regulations will hurt private firms more than public firms due to the size effect. And lastly, I found some investor gender effect. So generally speaking, compared to profit-driven investors, ESG investors are less attractive. But these negative effects are a lot more salient for female investors compared to male investors. And so I remember when I present this paper in Europe last year, and then some practitioners told me that, hey, yeah, I'm super surprised to see that you also found this effect in your paper. So she actually works in some impact funds, and then they were talking about some phenomenon called double soft penalty. So it's like, if you're female, people generally view you're more sympathetic and, more pro-social. But if you're women and also working in ESG funds, then people feel you are too soft, too pro-social, might have some negative influence on the startup's profitability. But for male investors, these negative effects are not that salient. So I think at least that anecdotal evidence from impact investors provide me more confidence about this interaction effects, regarding the investor gender. So overall, the main takeaway of this paper is just like the startups, they're not that warm about green funding. And then the question is, how do firms choose between ESG investors and profit-driven investors during their fundraising? They run experiments and also some complementary survey. And it seems like, similar to the VC side, startups, they are nice people that have positive preference towards ESG, but unfortunately, the profitability concern dominates. And then they don't want to partner up with green VCs due to those financial reasons. It's costly, they're less likely to invest in our startup. And so, sorry, we want to say no to those green fundings. But as long as you can convince them that green funding is not super costly, they are equally likely to invest in your company. They don't hurt your profitability. And then founders will say yes. Because now it seems green funding becomes a free lunch. You not only, it doesn't affect your future traction, but it brings you some free, positive social ESG impact. And then why not? Why don't we embrace that? The only issue is just like the cost or the financial concerns are the real barriers. And of course, we see substantial heterogeneous effects, right? So matching based on ESG happened, which means like, ESG startups prefer ESG investors. And then, in my other experiment on the VC side, it seems like, impact VCs also prefer ESG startups. So like this market segmentation is happening in the private market. And so lastly, we just have lots of heterogeneous effects, right? So Republicans, unfortunately, they don't like ESG. And then some industry are more friendly, some industries are not. smaller startups are more against ESG, and then female investors, they face more troubles. If they work in impact funds, they face more troubles attracting startups because people feel they're too soft. So pretty much that's about my presentation, and I'm super looking forward to my discussants' comments. Thanks.
Thank you, Ye. And Emanuele, you can share your slides and the floor is yours.
Sounds good. Okay, can you see my slides?
Yep.
Perfect. And again, apologies. I'm recovering from a bit of a few rough days, so my voice is not perfect. I can shout, but let me know if you don't hear me well. And thanks, Ye, for such a nice discussion. And I guess feel free also to interrupt me if I say anything wrong, given that it's been a bit last minute, and I hope I'm going to do justice to the paper. So let me jump straight in with a brief summary. So the way, like the backbone of this, I always like writing simple papers, so like I'm trying to like get to the gist of what this does. Is like the context is one in which we have, like, let's say Zhang is a startup founder and is looking for early stage financing. And what Ye does is that she offers him to play a little game and says, Zhang, can you rate a few hypothetical investors? After you rate them, I'll give you a list of 10 real investors that might be a good match for you. Okay. And the way it works is that like you create fake synthetic profiles whose features are randomized. What is nice about this is nice because let's say all the ESG investors were, let's say, located in Norwegian, in Norway, then you want to randomize location. If not, you're never going to be able to disentangle preference for ESG investors versus preference for Norway, let's say. So that and since ESG investors are different on many dimensions, of course, not just location, but many, many other things, this is a nice feature. So Zhang then, in this context, what it does is that it sees investor A and B. They look identical, except that A, and I'm simplifying, of course, except that investor A is saying that they invest in startups that generate positive environmental impact. This is actually a sentence taken from one of the many options that EA uses to randomize this. All is equal, when Zhang does this rating, we see that Zhang is less likely to pick investor A. And why? And of course, I'm jumping all the steps, mostly because he thinks that investor A won't really help him to become more profitable. It's not going to be value add. It's not going to be very good. And B, because investor A won't be interested. And we'll get into that. Maybe Zhang is not doing anything environmental, and so he thinks he's not going to have a chance. So why would he want to be matched to that type of investor? The implication of this, at least that's my interpretation of the implication, is that environmental funds will have more challenges matching to startups because they have to overcome everything else equal, the challenge, which startups don't want to talk to them. Let's say this will be like, I think, the gist of the message of the paper. Now, why should we care? I'm not going to go into the details. By now, I think we are all inundated with newspapers and articles and so on about massive growth of ESG. I've been working on it recently. We've seen huge LP capital inflows around the world going towards ESG-related funds. There is a big debate about whether ESG and funds are related. We have some interesting work that has been done, more work has been done, and so on and so forth. This is a huge area, and it's going to become only bigger. The nice thing of this paper is that is going to give us like a different perspective on the discussion, which is not really whether ESG fund outperform or not, but it's going to look at whether the demand differs for ESG funds. And we have a few papers that have looked at willingness to pay, which is a bit related, but this is kind of like a nice, pretty uncharted territory that EA is getting to. And I think there are many anecdotes to suggest that this insight is salient. I don't think it's uncommon to talk to people who would say, at least I don't know, I see it when I talk to people about working with big organizations like the IFC. They would tell you, oh, I don't want to work with them. They're going to ask me for so much due diligence. I'm going to have to show every emission and so on and so forth. And so this is something that probably is true in practice, to some extent at least. Of course, it's difficult to prove it. And that's where also like my discussion will be focused on. I like to, for me, experiments are beautiful when they're kind of like, they're giving us something tiny, but that something tiny, it's as perfect as it can be. And so we want to make sure that that's the case. And so in this case, I think what we want to overcome is the obvious endogeneity I was discussing. We only see typical equilibrium outcomes. So an experimental survey is a great way to get at this. I'm a huge fan of this experimental approach. I have a new paper on ESG in the labor market on this type of approach, done similar work with VCs in China and so on. So like definitely love the agenda that EA is pursuing. let me make a premise also to put all of us on the same page. What is this? This is nothing too complex. Information RCTs and conjoint type of studies, as they're called, are a great way to measure demand or preferences. I'll be sloppy, we'll get back to it, for endogenous characteristics. The classic example is the Bertrand Moulay-Nathan paper on resume audit studies, where basically they would send fake CVs, where they would randomize the name, and the name would be randomized along gender and race characteristics. And so based on the callbacks that these recruiters who don't know what's going on do, we can elicit essentially the residual preference or the taste for a given characteristic. In the case, let's say, for to capture gender discrimination or racial discrimination, okay? Now, the design is beautiful. That's why the paper has been so impactful. There have been many issues with deception. Deception is typically unallowed from all IRB. Resume audit studies somehow have been the only part that has been always able to be pushed. Some people argue because it was such an important point and so on and so forth. Regardless of that, this is very difficult in general to do without deception. And it's even more difficult if you want to do it with firms and investors, okay? These are not people who like to play games. These are not people that it's easy to spend their time on these type of things. So one solution that had been recently proposed is this Kessler and co-author, it's Kessler, Corinne and Sullivan paper in the AR, which basically creates a context, which is the similar setup that EA is doing, that I used in a paper on China LP-GP matching, which is basically allowing you to do the same thing, but without deception. You tell people what the rules of the game are, you give them an incentive which aligns the responses. Basically, the incentive is such that people will only respond for what is in their interest and what is truthful to them. If not, it makes no sense for them to play the game. So that's a way to get around it, right? And so this is a nice design. I've been using it a lot because in a sense, precisely because it's so difficult to study firms and investors, if you are able to collaborate with a partner typically, that can offer a strong incentive that is real and relevant, as I say below, and you can craft an incentive compatible mechanism to elicit preferences, then you're going to get these preferences well estimated in a very clean way. And I think studying, for example, I don't know, in my context in China, studying something that is difficult, for example, like getting at preferences for whether you want government money versus not, requires a cool understanding of demand. And so to do this, we need setups like this that could be helpful to be applied to this context. There have been a lot of discussion, think about PPP. We are wasting a lot of money, why, and so on and so forth. Many people were pushing to the story, because the demand is skewed towards the bad guys and so on. How do we estimate these things? It's hard to do it just based on data. Experiments are good for this. I mentioned, however, that these designs are powerful when the setting is strongly incentive compatible and when it's real and relevant. That is when the choices matter, I think. And that's what typically the fight, I would say, with the referees is going to be about. Do we get that? That is it going to be justified, all the effort, rather than just asking people what they think, which is the basic approach, right? We don't really like basic surveys because if we just ask people, it's interesting, but who knows what the hell they're saying? They might say something because you are asking them and you're putting them on the spot, but they might not really care about it and so on. All of those are interesting things. Surveys are useful, are descriptive, but the experiment is important to the extent that it can alleviate those concerns that we typically have with surveys. And so that's kind of like what I'm going to dig into in the few comments I have, which is essentially two main comments, and then I leave a few other comments for you. And then, we can discuss more in detail, but hoping I'm not missing anything. The paper is very rich. There is a lot of stuff. He has been doing this type of exercises for several different papers, so I won't be able to do justice to all the parts of the paper. So the first comment I'm going to have is making us think a bit whether the setting is real and relevant, and to what extent we can make it a bit more so. And the other main comment is going to be about incentive compatibility, which I'll get to in a second. So in the first comment, what I want to say is reemphasize this idea of these designs matter only to the extent that people participate to it because of these experiential incentives you give them, right? If they participate them for other reasons, let's say I see Mike in the corridor while he's getting a coffee, and I'm going to tell him Mike, give me a choice between these two investors. He might give me a choice, and he might be perhaps somewhat truthful, but is it actually a context that could be replicable? We don't want to do that. And so here, one concern, of course, is that the sample comes from a Qualtrics panel. Qualtrics, of course, pays firms to participate in their studies, right? That's how they make money. Sometimes they pay other survey companies to gather people who are part of their sample. I've used many of these things. There is nothing wrong, but you need to realize that many of these people, many real startups are not going to be on survey panels. And those who are, perhaps, are going to be very, very selected. And importantly, they are doing it also for other reasons. These are people who didn't sign in to participate necessarily for just this study, but if people are going to be paid about like, I don't know, 30, 40, 50 bucks per survey on many, many different surveys. So because of this is going to give us like a little bit of a different setting and a different sample that we want to keep in mind. The other set of questions I had on this is, and of course, touched on this and she did many things, and I really think like the Crunchbase sample helps, but the question remains of whether these are really quote unquote startups. Fully agree and incredibly sympathetic to the idea that we don't really have a definition of startups. Mike at Columbia is ultimately going to give us a definition. It's going to have a book called Startups, and it's going to give us a definition we can always forever use. Right now, we do not have that. And so in a sense, anything goes. But in this case, I like to go by sort of like common sense. And I would think of startups in this case as startups that perhaps are looking for VC. And perhaps in this context where we're looking to estimate demand, we might want to have startups that might have some bargaining power, right? If I go to someone who has this idea that probably is a very, very crappy idea that's never going to get funded, and I go there and I'm going to give him choices between investors, he can choose whatever, but probably he's never going to get money. And perhaps if he's going to get money, it's not going to choose the terms, right? And so given that, and of course I'm exaggerating, but that is something that is important to understand issues such as external validity. Similarly, we should ask the question of whether this is, and I think this you can get this a bit more here, but like whether the free list of potential VCs, which mostly, I guess, more or less come from like, let's say, PitchBook or the typical commercial databases, whether that's a real barrier for firms, for startups who are about to raise financing. It could be, and to some extent, I believe it. PitchBook is expensive and so on. And I think finding someone that has the right characteristics might be somewhat costly. It's unclear to me how much that is the real constraint compared to actually get to a conversation with a VC, compared to actually having something that is good enough and attractive enough for what VCs are looking for, and so on. And so I think this is something that it's always like the experiment. Sometimes comments are tricky because the experiment has been done, but still these are things that hopefully can be discussed in the writing, or perhaps we can do some more. The Crunchbase example, as I mentioned, is that nice direction. It'd be nice, of course, in another world in which you could do it, and perhaps your nano search tool can become an actual full-fledged company that gets lots of action. But it'd be nice if this could come not from the Qualtrics panel, but from an actual reputable industry player inviting firms to actually do something that has real stakes. The more you can get to that world, the more I think this will have a lot of bite. Another thing that I think you could do is like similar to what you do at the end, but I would do it just with that purpose in mind, which requires a slightly different design. It'd be nice to know how much they would be willing to pay for this incentive. Like if we actually put them on the spot and you tell them like, I'm going to give you this this list of like 10 investors. Would you pay $1,000? Would you pay 500? Would you pay less? And of course, then we can start playing around with the idea of like, how much is this? Is it relevant? Do people actually, if they see there's a friction for which they would be willing to pay no more than $50, and they are a company making, let's say, I don't know, $10,000 a month, is this an actual friction that is relevant in magnitudes? And you're never going to get, people say lots of things and people are always very reluctant to pay, but at least having something like that can be a nice ammunition to someone like me who would say, okay, but I'm not convinced that perhaps these guys are actually thinking too seriously about it, and I would like to say more. Even if they can put actually $50, I'd be very happy to see that, because that would give us something that is definitely tangible. And the second question I had, and this is kind of like remains a question mark, but and sorry for the audience if this gets to be too much into the nitty-gritty of the paper, but again, it's an experiment. I think the useful comments are on the nitty-gritty. To me, the question remains of whether the evaluation questions are or not incentive compatible. So I'm copying here, I put Camille just to do justice, not just to Zhang, but also to Camille as an organizer as well. And so like, I copy the way at least I think, correct me if I'm wrong, but from the appendix, what one of the key questions is. The question that measures whether they be interested, what I would call interest, which is a typical measure you would like to get. In a resume audit studies, whether I want to actually apply, I want to actually call the applicant, right, the job applicant to the post. That would be the interest. Here it would be, would I actually want to connect to the potential investor? And so the way the question is framed to me is like, and EA is not hiding. This is part of like the way she wants to capture this, but it's capturing not just the interest, it's capturing the willingness to have a meeting to discuss the financing, considering both the potential interest in the startup as well as the evaluation of the ability of the fund to help the startup. Okay, and so in a sense, this mixes up a lot of things. For sure, and that's, I think, an experimental statement is correct. This is not incentive compatible to capture interest in just everything else equal. Do I like this fund? If they were willing to give me money, would I pick Zhang fund or would I pick Mike's fund? Okay, that would require a question that says, how much do you like this investor? Everything else equal, and let's hold everything else fixed, which is difficult to do. But let's say we do it. If you tell me that you like Zhang more than Mike, I will give you an investor list that contains a lot of Zhang and very few Mikes. That would be incentive compatible, because then I have no reason to say I prefer Mike if I actually want Zhang as an investor. Okay, that's what to me incentive compatibility is. In this case, I could say, oh yeah, I prefer actually Zhang because I think Zhang is relatively low key. He would like me. Mike is a better investor, but I'd rather get to chat with Zhang. Or maybe I'm going to say, oh, I actually think Mike is better, but Zhang can give me better advice. And so because of this, my answer will be a mix of these things, which are all helpful and all very, very interesting on their own. I think what you're capturing is extremely interesting, but it's not necessarily the typical way this resume audit study would work, in which they will give us a precise preference or demand for a given feature of the investor. Again, maybe that's what we want to capture, but that's something.
Elaborate a little bit more, because I remember in the original IRR experiments, the goal is that all the evaluation questions will enter the recommendation algorithm, and so that any deviation from your truthful evaluations will hurt the match the quality, right? And so that's the beauty of the matching incentive.
No, agree, but we can get to it into the detail later. But like, what my point is, whatever, and if you're matching if you're giving them actual investors who are being selected based on the answer to these questions, what I'm saying is that the type of investors you give them are gonna be a mix of not just the investors they really like the most, it's gonna be the mix of the investor that they think they can match the most, they can give them better advice, and so on and so forth. Which if it's what you want to capture, that's good, but it's not the demand for the investor. We can get back to it, but there is some background noise I hear. I don't know where it is coming from. And so, again, remains very interesting, but interpretation changes a little bit. And so to me here, the idea was like, the more we can go to that design, the more I think the value add of this paper will shine. That said, let me say that like, I do believe the interpretation. I think that's exactly what's going on. I think part of if I had to bet my money based on just intuition, I would say that the reason why we see a negative preference for E and no effect on the others, for example, or at least large is that people that have no chance of showing environmental impact are gonna think that like an environmental investor is not gonna give the money. And so why would I want to meet with them? So a lot of it will be driven by fit. Now for S and G, everybody probably can fight their way through saying that they have an equitable compensation structure and so on and so forth, or maybe less so. But the point is that a lot of it is likely going to be driven by the fact that I don't think I'm going to be a good fit for them. So why would I want to match with them, for example? Profitability is also showing up, and so I believe it. But all of these things are going to be, in a sense, like the profitability question is another example. There is no incentive compatibility. I'm just stating whether they will be profitable. There is no reason why saying that they are profitable or not is going to increase the matching. And so in a sense, it's nice and descriptive, but it's going to be a bit of a deviation from the IRR. Let me, I think, conclude because of the timing, I was missing where we stand. But I think I had other comments. I think you can discuss more and perhaps tell us a bit more about like whether we can wait to have like a representative sample in some ways. But I think it is an interesting sample in itself. It would be nice to know whether like just having any ESG signal rather than the disaggregation actually helps. All of these are interesting because I think the disaggregation is interesting per se. And the payment game, I can follow up later a little bit more, but I think there are maybe other ways to get around it. I'm happy to discuss in more details later. Let me wrap it up. What do we find? We find that startups or SMEs, I think, depending on how we want to look at them, have several reservations about environmental funds. And I think it shows in there that this is largely to do concerns about the value add they bring and the fit that some startups may perceive to have with this type of funds. Startups and SMEs don't care too much about the broad ESG or S or G funds. And again, I think that's also interesting per se, to be honest. Any result with this type of experiments is interesting as long as we believe the experiment. And so always easy to find improvement in papers, but I actually do love the approach. And if anything, it's because I'm so close that I get so much into the nitty gritty, but hopefully that can provide some useful feedback. Where would I push more on the paper? It would be you can push a lot more on the implications, because the implications are very nice. The simple point I made at the end of slide 1 about, look, guys, we think a lot about the supply of this, but if people are shying away from getting money from the environmental funds, that has implications. That has implications for how you should target startups, what type of startups you should target. And this gets to the two, I think, most interesting parts of the paper, which are the backfiring and other distribution effects. I think to me now there's going to be so much work on understanding this backfiring of ESG, especially along political lines. I think the fact that different people like different aspects of ESG more or less, and the backfiring differs, has a lot of distribution effects. So I think you have a lot of that, and to me that's a very, very exciting part of the paper. But that's the comments I have. Hopefully they're helpful.